All right, so here we are diving into the requirements of ARC Section 80 regarding performing compilation engagements. And so this video is going to be about independence, but before we jump into that, we want to reiterate here that when we're performing compilations, we're required to comply with ARC Section 60 regarding the general principles for engagements performed in accordance with SARS. And so we've done several videos on complying with Section 60A, so you can go to those videos if you like, but we just want to make sure that we comply with those general principles in addition to the specific principles which we're going to through right now for ARC Section 80. All right, so let's dive into independence. It says here that the accountant must determine whether the accountant is independent of the entity. So we notice here that it doesn't say that we must be independent in order to perform the engagement. It merely says that we must determine whether we are independent. And that's because when we're performing a compilation engagement, it's okay if we are not independent, but we just have to disclose that we're not. So let's go down to this reference paragraph A8 and get some more understanding on this. Okay, so here we have the explanatory material around independence, and it tells us the AICPA Code of Professional Conduct provides us some authoritative guidance with respect to independence, and we're going to go take a look at that in just a second, but let's continue through here to understand high level what this means in relation to compilation engagements. So it says that if it turns out that we're not independent of the entity, then we need to modify our accountant's compilation report to notify the users of that report and the financial statements that we were not independent when we performed the compilation engagement. Also, we want to understand that independence is not just a matter of fact, it's a matter of appearance and of mind. And so the thought is that if we are independent, then we would be impartial and fair to the users of the financial statements. So let's now that we understand that it's okay for us to not be independent, we just need to notify or modify our accountant's report to notify the users of the financial statements that we were not independent when we performed the compilation engagement. So let's go to the AICPA's Code of Professional Conduct and understand how we determine whether or not we are independent. And it says here that a member in public practice shall be independent of or in the performance of professional services as required by standards promulgated by bodies designated by the council. And so in this case, that would be the AICPA and the performance of a gas audit. And so the problem with independence is that there's an infinite number of relationships and circumstances for which the appearance of independence might be questioned. So the AICPA here has put together more of a framework to understand independence as opposed to a lot of specific matters that might be risk to independence and might not be. But so in using that framework, there's several terms that we need to understand. First, an acceptable level of independence would mean that a reasonable and informed third party who's aware of what's going on would be expected to conclude that the independence is not impaired. So this is not only an independence of fact, but an independence of appearance. So would someone else looking in maybe come to the conclusion that independence is impaired? So what does impaired mean? So it means in connection with independence, being impaired would effectively extinguish the independence. So when the member's independence is impaired, the member's not independent. So there may be several situations that look like could impair the independence of the auditor. In those cases, auditors should employ safeguards. And so those are actions or other measures that may eliminate the threat or reduce the threat to an acceptable level here. And so those threats are relationships or circumstances that could impair independence. So in performing our analysis of whether or not we're independent, we first take a look at some threats, what looks like it could impair our independence. And so then we try to see, well, are there safeguards that we could put in place that would prevent us from being impaired even though we have that threat? And after that, we gain an understanding of is our independence, or rather our threat to independence, now down to an acceptable level after we've employed those safeguards. And if it turns out that we can't put together safeguards to eliminate that threat, then we're impaired and we're not allowed to issue a report on the engagement. So let's go take a look at what are some threats that might impair our independence. I believe there are 7 of these high-level examples of threats. So the first one is the adverse interest threat. So this would mean that the interests of the client and the auditor are opposing each other, and so then the auditor might not act objectively in regard to the audit. So an example of that might be that the auditor or the client are suing each other, so they have an adverse interest in each other. The next example would be maybe the advocacy threat. And this would mean that maybe the auditor is an advocate of the client through promoting the client's interests or positions to the point that independence is compromised. So examples of these might be that the client's securities are being issued in an IPO. The auditor provides expert witness services to the client, or the auditor represents the client in a tax court or other public forum. So in that case, the auditor might have an incentive to make things look better for the client's financial statements and be its advocate. Next, we have a familiarity threat. And this might happen if the auditor and the client have had a really long relationship. And so after that long relationship, the auditors become sympathetic to the client's interests and too accepting of the client's work. And so that might come about if the auditor has a family member working in a key position of the client. The partner of the audit firm has been working on that engagement for a really long time. A member of the firm has become, or a member of the auditing firm has become a key employee or director of the client, or a member of the engagement team has a close friend who is in a key position at the attest client. So being too familiar with the client or in relationships with those at the client might be a threat to our independence. Next, we have the management participation threat, and this might come about if a member of the audit team would take on the role of management or assume management responsibilities for the client. And this might come about if someone on the engagement team is an officer or director at the client, if the auditor accepts responsibility for designing, implementing, and maintaining internal controls for the client, or if the auditor hires, supervises, or terminates the client's employees. So in general, the auditor is precluded from performing any duties that might be more appropriately performed by management. So next we have the self-interest threat, and this would mean that maybe the auditor or someone on the engagement team could benefit financially or otherwise from an interest or relationship with the audit client or people that are associated with the client. So this could come about if the auditor or someone on the engagement team has a financial interest in the client. So if they maybe own shares of the company, maybe they have a loan at the client, or if they own a substantial portion of the shares of the client. Or let's say this particular client, or rather the audit firm gets a substantial portion of its revenue from this client, or there's some kind of joint venture with the client. So in all these cases, the auditor might be more inclined to be less strict on the audit or less strict on misstatements in an effort to maybe earn a better return on the company that if they own it, or a better chance of their loan getting paid back, or a better chance of keeping the client since it's a large part of its revenue. Next, we have the self-review threat. So in this case, the auditor might, if he had previously provided advice to the client or performed certain functions, for instance, preparing source documents on behalf of the client, then he would be reviewing his own work and might not be objective in doing so. And in fact, certain self-review threats, for instance, preparing the source documents, there would be no safeguards that could eliminate that threat to an acceptable level. And finally, the undue influence threat. So this might come about if the client has a significant influence over the auditor. And so, for example, the auditor might subordinate his judgment on the audit if the client or another third party has a particular reputation or expertise, and maybe they have an aggressive or a dominant personality that persuades the audit, or the client attempts to coerce or exercise excessive influence over the auditor. And so that might come about if management of the client threatens to replace the auditor over a disagreement, or the client pressures the auditor to reduce fees through making there be less audit procedures, or maybe even the client provides a gift to the auditor to influence him. So in all respects, the auditor needs to keep an eye for those undue influence threats that might persuade the auditor to not be as objective. So now that we understand a lot of different types of threats that to the independence that the auditor might come across, let's understand some of the safeguards that could be put into place to mitigate those threats. So as before, we saw before, these safeguards should be effective enough to either eliminate the threat or reduce it to an acceptable level. And so there are three categories of safeguards. The first one is created by profession, legislation, or regulation, and that might, for example, AICPA issues ethical standards, so that might be a safeguard to particular threats. Next, there might be safeguards that are implemented by the client, but it's not possible to solely rely on those to eliminate or reduce the significant threats to an acceptable level. And the third safeguard might be implemented by the firm. And so this might be policies and procedures to implement the professional and regulatory requirements. And so the effectiveness of these safeguards depends on a lot of different things. For instance, the facts and circumstances specific to the particular situation, the proper identification of the threats, and whether the safeguard is suitably designed to meet its objectives, the parties that will be subject to the safeguard, how the safeguard is applied, the consistency with which the safeguard is applied, who applies the safeguard, how the safeguard interacts with a safeguard from another category, and whether the test client is a public interest entity.